In today's episode of the MSA Rental Market Update, we are looking at the Austin rental market for multifamily properties, more specifically conventional apartments. So you can see that the Austin metro statistical area is drawn out by CoStar here. Give you an idea where it is. I've scrolled out so you could see Dallas to the north, San Antonio to the south, Houston to the east. Here's Lafayette, Louisiana, New Orleans, Louisiana, Jackson, Mississippi up here. Kind of gives you an idea of where in Texas this is kind of located within that triangle of these four major metros. So now that we know where it's located, let's take a look at the filters and see what we are excluding. So we are excluding all corporate, all military, all senior, and all vacation, and we are only including market and market affordable so that we are only looking at conventional apartments. If we go to location, you can see that we are in market, metro statistical area, and Austin, Texas. So let's go take a look and see what the analytics tell us for the rental market in the Austin MSA. We'll look at all three asset classes first, and then we'll break out each one individually, Class A, Class B, and Class C. So let's go take a look at the analytics. Here is the supply snapshot for the Austin metro statistical area. You see we have 2,255 conventional properties, totaling 272,705 units. There are still 37,964 units still under construction. In the last 12 months, 6,910 more apartments were rented than went vacant. And the prior 12 months before that, 18,464 more apartments rented than went vacant. So a pretty large drop in absorption for the Austin market, and the vacancy shows us that. We were at 7.1% a year ago. We're at 9% today. A very, very slight year-over-year rental increase from 1636 to 1650, but we'll see what it looks like quarter over quarter. As usual, we're not looking at the capital markets. We are only paying attention to the space market. So if we scroll down slightly, we can see that the long-term occupancy average over the last 22 years is 91.75%, and it is currently sitting at about 91%. Because we have such a small window here, so this market on the low end is around 90%, and on the high end is close to 93.5%, we can see that even a small difference between the long-term occupancy average and the current occupancy can make a big difference on that market cycle chart. So all that said, and we'll plot where this is going to be when we get to the end on the market cycle chart. So let's go take a look at our data and see what the data tells us for all three asset classes combined. So here is the rent analytic data for all three asset classes in the Austin metro statistical area. We do not look at asking rent. We don't care what they're asking. We only care what they're collecting. So if we look at effective rent for Q1 in 2022, it was at $1,644 a month. Went up to $1,700 in Q2, and then in Q3 we dropped to $1,665, dropped to $1,630 in the fourth quarter, which was actually lower than what it was in the first quarter. We do show that it went up $3, so pretty much stabilized between the fourth quarter and the first month of the year. CoStar has said that the January data is good, so we're going to trust them in this large market. And so we will say that there was a very small $3 increase per month in January for the Austin MSA. Let's take a look at our deliveries, construction, and absorption and see what that tells us. So we had 4,878 deliver and only 1,748 absorb. That's going to affect our occupancy, and it did. It lowered that occupancy by 1.1%. Then we had 3,802 deliver in the second quarter and only 2,570 delivered, and the market went down another 0.3% in occupancy. Then we had another 3,373 deliver and only 1,694 absorb, with another 0.6% drop in occupancy. Then another 3143 deliver and only 1235 absorb, with another 0.6% drop in occupancy. Then in the first month of January, 968 delivered, 789 of those absorbed, so no change in occupancy in January, which could indicate that $3 increase. So we are definitely at a point in the market where these owners are starting to get a little worried because they are not keeping up with absorption. We are absorbing. It's not like we're negative absorption, but with the amount of units that are being delivered to the amount of units that are being absorbed, there is definitely a slowing trend occurring here. So let's take a look. And we still have 37,624 units to deliver. Actually, 37,964. Looks like another 300 unit property went under construction. So that is a big number. We'll see how this market looks moving forward. But first, let's go take a look and see which asset class may be dragging this down, or if all three are sharing the load. So let's go look at the Class A data first. Here is the Class A rent analytic data. There are 327 properties totaling 100,912 units. Looking at effective rent, in the first quarter of 2022, we started at $1,872, went up to $1,943, and then down to $1,874, almost to where it was in the first quarter, down even further to $1,830 in the third quarter, and then a very slight uptick in the first month of 2023. And we're starting to see a year-over-year decline in rent growth as we move into 2023 for the Austin market, which it hasn't seen in quite some time. So let's see what deliveries, construction, and absorption tell us. So we can see that a lot of the deliveries happened in the B class, but if we look at the A's, 2,400 delivered in the A's, only 628 in the first quarter of 2022. Really low number, and we saw a major drop in occupancy, 1.7%, between fourth quarter and first quarter of 2022. Then we had another 1,557 deliver and 1,246 absorb, with another 0.1% drop in occupancy. Then we had 821 deliver and 866 absorb, which ticked us up 0.1% in occupancy. Then another 920 deliver with only 327 absorption, losing that 0.1 growth, down 0.5% in the fourth quarter. And then 102 have delivered with 349 absorbing in the first month, which explains our $5 increase in the month of January, bringing our occupancy up to 91.3. So it looks like that the demand supply fundamental principles are working appropriately for the Class A market inside the Austin area. So it is not Austin solely dragging it down, because we are seeing some absorption, pretty similar to what we saw with the overall. So let's take a look and see what story the Class B properties are telling us. So here is our Class B rent analytic data. There are 647 properties totaling 123,046 units. Looking at effective rent, we started first quarter 2022 at $1,539, up to $1,640, and then once again, as with the other asset classes, down to $1,619, down to $1,580, and for the first month of January, stabilized at $1,580. So let's see what deliveries and absorption tell us here. So we can see we delivered 2,214 in the first quarter, absorbed 1,199. So a slight downtick of about 0.7% because of that low number of absorption. Then we delivered another 2,048 and only 1,283 absorb, taking us down another 0.6% in occupancy. Delivered another 2,048, only 885 absorb, taking us down another 0.9% in occupancy. Then 1,893 deliver, only absorbed 667, which took us down another 0.8% in occupancy. So Class B is definitely not absorbing as fast as the Class A is. which is a very interesting tale. So the Class B is dragging this market down slightly. Then we had 866 deliver, only 471 absorb, and occupancy went down another 0.3%, yet we did not see a decline in the rents, even though we had another decline in occupancy of 0.3%. So that's an interesting tale. So other than that first month, the Class B market is acting appropriately to its demand-supply fundamentals. Let's go see if the Class C will show this same trend or if it will tend to look the way the rest of the Southeast does and look like a better asset class than it really is. But let's see what the story it's telling us. Here is the Class C rent analytic data. There are 1,015 properties totaling 48,572 units. Looking at effective rent, first quarter was $1,264, went up to $1,296, up to $1,303, very, very slightly down to $1,302, and up to $1,307 in the first month of 2023. So that says that the market is growing as we've seen in the rest of the Southeast, but let's see what absorption tells us, and should it be growing or should it be declining? And if we look at absorption, not a very good tale. Now, I wouldn't look at this under construction and delivery data. This is false information. You don't deliver Class C units to the marketplace. They are probably Class C areas and documented that way by CoStar, some lower areas that they are giving weight to for giving them under construction and deliveries. But these would be delivered as Bs. They would not be delivered as Cs. So we had negative absorption in quarter one, some positive absorption in 2, negative absorption in 3, positive absorption in 4, negative absorption in the first month of 2023. So not telling us the same story that the rents are telling us. The market is saying that we are not liking what we're seeing for rents, even though we did have good positive absorption in the fourth quarter. Overall, they're saying that these rents are a little high. We are a little higher on the occupancy scale than the rest of the asset classes. So we're sitting at about 7.7% vacancy. The rest is sitting right around that 9% vacancy. So the owners could be trying to push it to that 9%, but typically when they get down to around 7% is about the time they start lowering those rents so that they can keep it above that 7%. So interesting tale in the Class C market. I think we're going to start to see this trending downward as this absorption wanes like this, because there's no way that these owners are going to be able to afford to let these apartments go vacant very much longer. I think that we can definitely call this entering the recession phase. So if we pull up our market cycle chart, we have deliveries entering the market. We know that we are to the right of the NOI line because we have deliveries. We are showing the rents declining. We are showing absorption slowing in Class C's declining. A's and B's did not show any negative absorption, which has been a rarity lately. We've been seeing a lot of negative absorption in both A and B across most of the Southeast and Sunbelt. So very interesting that Austin's A and B stood strong in absorption, although that absorption was slowing. And it is below this long-term occupancy average, but the rents have not declined a lot. They've only declined a little bit. So I'd probably go ahead and plot it very close to this long-term occupancy line, but starting to enter that recession phase. We'll look at it another quarter and see if it pushes it down, or if that little bump we saw in January continues and maybe pushes it back up into the oversupply phase. So we're kind of hovering right here around the long-term occupancy average, in between oversupply and recession for the Austin market. So that does it for Austin. Stay tuned tomorrow, where we are going to go take a look at the San Francisco Bay Area of San Jose, California. So the San Jose metro statistical area, which is where I grew up, believe it or not. So It'll be very interesting to see what that looks like. So have a great rest of your Monday evening, and I will see you guys tomorrow.